I want to talk about thrifts and finance firms. These are firms that are basically the alternative to banks. They're among the oldest ways of banking. And they're used actually quite a bit here in Hawaii, more than I would have thought. So the idea of the savings bank dates back to the 1700s, and basically it was a way for the poor to save. Um, in Germany, a country famous for saving money, um, you had First Savings Bank that was formed in 1778. Actually, I was just reading about, somewhat interestingly, Greensill. Um, sorry about that. In Germany, there was a bank called Greensill Bank that actually just failed. And actually, investors lost quite a bit of money um, when it did fail. Massachusetts state government created a savings bank in 1816. As a savings bank, all these savings banks are insured by the FDIC, the Federal Deposit Insurance Corporation. And basically, what that does is it insures deposits up to $250,000. So you'll get your money back as long as it's $250,000 or less. Savings banks are pretty small. The assets are less than $1 billion. You see them a lot in the Northeast. Trying to think of one that I know. Would be one that I would know. Um, yeah. Sorry, I'm just trying to look. Give me 1 second. Yeah, this one would be one. So almost. Yeah. So one of them would be Marquette Savings Bank in so this little rinky-dinky bank. Um, it was started by members of the Knights of Columbus, the Catholic organization. 38 local businesses formed this bank to encourage local residents to basically save their money and eventually own a home. There, I mean, this thing's got nothing. I'm trying to. I'm not even sure if I can find out how. They have 12 offices, and they have um, $840 million. Their main office on Peach Street. I mean, it's small, really, really small. But this is the foundation of the banking system in the United States, are these savings banks. Then you've got your savings and loans. The savings and loans, what they're designed to do is they're designed to collect money and then funnel that money with the goal that people are going to put it into their homes. Sometimes it's called a building and loan, home financing. The only purpose of this is the building of homes. So this would be like in It's a Wonderful Life. Um, that movie with George Bailey, um, that was a building and loan. Depositors saved money with the idea that eventually they would use that money to then buy a house. Um, let's see. Sorry, I'm just looking up. Yeah, for the most part, I would say American Savings Bank, which is actually owned by Hawaiian Electric, for the most part, is a savings and loan. By my definition, it basically, even though technically speaking, it's not a savings and loan, its primary purpose is basically issuing loans. Um, and back when American Savings Bank started, it used to be called American Mutual Savings and Loan, which obviously would be a savings and loan. Um, okay. Now, what you have in the 20th century is you have the loan system itself is getting more complex. So now you have in the 20th century, you have these thrifts, which is another um, it's a special bank basically. Um, what the thrifts were able to do is they were able to do things that commercial banks couldn't. Thrifts could had more freedom to charge whatever interest rate they wanted. They could issue dividends. Commercial banks throughout the 20th century, up through the 1970s, early 1980s, they were regulated and they couldn't offer a higher interest rate than a certain amount. Um, what happened in 1980 is they got rid of that requirement that banks had to pay a certain interest rate and offer particular services. It was called the Depository Institution Deregulation and Monetary Control Act. It allowed there, for instance, to be checking accounts that paid interest. We even created the notion of a checking account um, that paid interest, which at that time was called a now account. Um, I don't think you would find the word a now account anymore. It's just a checking account that pays a very little bit of interest. That's now allowed by getting rid of Regulation Q. The problem with that deregulatory act of basically withdrawing from the establishment of the interest rate is that banks then became much more competitive and the savings and loans became particularly competitive. And they basically um, offered lots and lots of loans to be able to generate interest. So what they ended up doing is lending to incredibly risky projects, which by the late 1980s causes the savings and loan crisis. Um, I think the book is generous when they call the savings and loan crisis misaligned incentives. Um, the problem, as this slide points out, is that the savings and loans took on too much risk. But the problem was that the consequence of taking on too much risk actually fell to the public. So the public was the one through the FDIC that had to basically bail out the depositors in these risky banks. Um, and so the savings and loan crisis in the 1980s really rocked to the core the essence of banking in the United States. And it certainly got the government at least a bit more involved in the regulation of banks, which they had again retracted themselves from with the 1980 Act. So what do we get? We get the 1989 Financial Institutions Reform, Recovery, and Enforcement Act. Fire! Fire! Basically created an Office of Thrift Supervision, the OTS, and that is the agency that continues to exist to this day. Fire also provided some money to basically close down the savings and loans banks that had basically failed, and it created the Resolution Trust Corporation. And what this did is it basically was an entity that sold off the savings and loan banks that had failed and basically tried to get the most money they could. Part of that, one of those actually fed into American Savings Bank here on the islands, because what we had here in Hawaii before American Savings Bank, before it was called American Savings Bank, it was called American Savings and Loan Association, and that basically failed and was bought out by American Savings Bank. American Savings Bank bought American Savings and Loan Association. And it did that as well as bought the Bank of America's operations in the late 90s to become the bank it is. When it bought the savings and loan assets, it got those from the Resolution Trust Corporation. Again, these thrifts, their primary activity here is lending for real estate loans. Again, for the most part, American Savings Bank today qualifies under this, whereas First Hawaiian lends out a great deal less for for residential home loans. Commercial loans, on the other hand, are very little part of a thrift's lending, whereas for First Hawaiian Bank, corporate commercial loans are much more important than most of the other types of lending that they do. I actually was a depositor in Washington Mutual. This was the nation's largest thrift. It failed in 2008. I think I had it was the largest bank to have failed that required FDIC involvement. I had about $16 in my checking account. So I got issued a check. My deposit was basically insured by the taxpayer. Credit unions. Oh God, I don't even know where to start with this one. Hawaii loves its credit union. Don't get me wrong. I belong to a credit union as well. I have Navy Federal Credit Union. And yeah, I mean, it's as a credit union, they're known for charging very, very little in interest. And it's primarily because they don't have shareholders that they have to pay. The members are the owners of it. They don't pay corporate taxes, and they're owned by their members. And actually, Navy Federal is the nation's largest credit union, the largest credit union in the United States. Canada also has a lot of credit unions. It's just their general preferences for banking. We have them a lot here in Hawaii because in Hawaii, we obviously lack the big national banks like your Bank of America, US Bank, Citi, those kinds of things. So credit unions and smaller banks basically rise in its place. Now, in general, credit unions are not without their controversy. They don't pay taxes, so they are being subsidized by the government. But, you know, most credit unions basically pride themselves on the fact that it's basically local banking. You know, the bank has a very small geographical presence. You know, again, Navy Federal, you have to be in a particular membership, right? You either have to be a veteran or a family member of a veteran to even have an account, right? Other ones are like you have to live and work at a particular type of business, like the restaurant workers, right? Or you have to live and work on the island of Oahu, or some sort of you know, other kind of restriction. The question would be is, do we want to, as a federal government policy, do we still want to subsidize them? Then you got your finance companies. The big one here in Hawaii would be something like Home Street Bank, where basically you have a lot of auto loans, mortgages, um, bonds for like PV solar or other home repairs, consumer durables, I don't know, money for a new stove or oven. So these finance companies also are subject then to a lot of different regulations. But in general, um, they're subject to different regulations, but they are fewer, and they certainly don't carry as much force as the federal government in the way that it supervises banks. So also, what the reason why they exist though as well is because businesses like finance companies, when they need to fund their invoices, right, where they might not get paid for 90 days after the item is delivered, or because they want to build up their inventory, that would all be exactly the kind of thing that a finance company would do. Whereas a bank might have a much harder time financing inventory, especially if the business is relatively new. You've got your, when we look at the type of financial finance companies that are out there, you've got your captive sales, sales finance, big subsidiaries, and international finance. Let's start with captive sales first. Basically, this would be you need financing to purchase this big expensive thing. When I graduated from college, I didn't accept the offer, but one of the first job offers made to me was I went to college in the Midwest of the United States. And so that bears mentioning because one of the first job offers I had received was from Caterpillar, the huge construction equipment manufacturer, and more specifically in their finance division. So that would have been businesses buying a big bulldozer and then needing to raise the money to buy that thing. Then you've got your sales finance companies. They would basically finance anything as um, long as you meet the loan criteria. So now it would be, I need money for my bulldozer. I'm not going to borrow it from Caterpillar. I'm going to borrow it from, well, GE Capital. GE Capital would have lent me the money for it. Then you've got your bank subsidiaries. Bank subsidiaries is a finance company. They basically, the parent is basically the parent corporation, and they offer other kinds of products that a traditional bank wouldn't be able to sell. And then you got your independence finance corporations, companies, payday loans, title loans, really predatory types of lending out there. They're not raising their money. These finance companies are not raising their money with deposits as typical banks do. Instead, they borrow money in the markets that they then lend to others, or they get their money from other private investors. You saw these finance companies a lot perpetuate and augment, make more severe the housing crisis. And that was because they would, these finance companies would issue these adjustable rate mortgages. Let's see, in The Big Short, that was those like two sleazy guys, the ones that like told them to like talk to that stripper because the stripper was one of their clients. And they were kind of like the, I don't know, really swarmy kind of guy. Let's see here. Let's I mean, these two swarmy kind of guys. I'm gonna click on images. It's not them, not them, not them. Oh, this part right here. So if you watch this one, when they were talking to this guy, the Florida scene, I guess this is scene 5. That would have been, again, I don't think you guys can hear it. I try to watch it on here.
How many loans do you write each month?
About
These
What
guys.
was it 4 years ago?
10, maybe 15.
Yeah, I was a bartender. Now I own a boat.
You own a So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah.
Yeah, I'd say about 90%. Yeah, the bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck on my job.
Anyway, I'm not
Even
sure
if they
what
have no money?
watching this. Anyway, but those would be the finance companies certainly didn't help the housing market crisis that existed in 2008, 2009. Again, unfortunately during these chapters, I really wish that this class was in person, because I could talk so much more detail than even what the chapter is talking about. It's just kind of the unfortunate part of COVID and the way that this course has to be delivered.